Good morning, everyone, and welcome to our retirement planning webinar entitled How Much is Enough? My name is Harry Plunkett, a wealth planner based in our Worcester office, and with me today is Toby Carpenter, Wealth Planning Director based here in Birmingham. Good morning, Toby.
Morning, Harry. Morning, all.
Between us, we have a great deal of experience providing clients with personalized retirement planning advice. And today we're aiming to give you some food for thought and general guidance on your retirement planning journey. We're going to be covering understanding your income needs in retirement and the impact of inflation on this, how to plan for uncertainty, thinking about different income sources and tax considerations, and various risks and how to mitigate them. We've based our content today primarily on the UK and more specifically English tax and legislation. But if you'd like a more targeted conversation to your specific circumstances, please speak to your usual contact. So firstly, Toby, good morning.
Morning.
I think a really good place for individuals to start thinking about their transition to retirement is by understanding exactly how much income they're going to need when they no longer work. Where should they start with working that out?
Absolutely, really good question. And I think the first thing to say is obviously it's completely unique to each individual. There isn't a simple answer to this. And I also think that sort of the changes that are going on in the world at the moment and the recent budgets and the big changes that have been mentioned there is really bringing this again to the forefront, and the importance of thinking about this in more detail to the forefront of people's minds. I think a good place to start, if we sort of go back actually and think to workplace pensions, to final salary schemes or defined benefit pensions as they were called, and think about what they were trying to provide for individuals. Namely, approximately 2/3 of someone's final salary. You'd work for 40 years in a 60th scheme, you get 40/60th and 2/3 of your final salary. And that sort of seemed to work. So in the absence of anything better, that's a pretty good starting place, we think, to work from.
And if someone wants to evolve upon that to start to work out how that relates to them, I find a really good place to start is thinking, what are the must-haves and what are the nice-to-haves in retirement, what we might call essential and discretionary.
Absolutely, because it's not just about having enough, but understanding what enough means to each individual. And you're absolutely right. The most important thing to get right straight away is to ensure that standard of living is maintained, or the desired standard of living is maintained throughout retirement. And a good way to start thinking about this is expenditure doesn't really change that much in retirement from what people are spending today, but it's more about looking at what perhaps are we not going to be spending on in retirement. And typically that's servicing debt. So whether that's mortgages or other loans, and more often than not, children, but they sort of can remain a financial burden perhaps for slightly more elevated years. But principally that's the way to start thinking about it. And then on top of that, building in, as you talked about, those nice to haves, some of those big fat holidays that you might want to go on, or other plans and dreams that clients have thought of.
And it's also really important to start to give thought to how those spending patterns might change through your retirement as well. I know I have, and I'm sure you have as well, spoken to clients who in the early years of their retirement, when they have their health and energy, they like to spend a lot of money on holidays, and they've suddenly got a lot of time to travel and they want to make the most of it. But that does tend to taper off typically as health starts to get in the way, energy starts to decline.
Yeah.
And actually, importantly, past about 75, the prohibitive cost of travel insurance.
And particularly if you've had pre-existing health conditions, you see it becomes really expensive to insure that, particularly if you go over to the States. So yeah, you see this sort of clients in the early days of retirement have the time and the means of which to enjoy those things, but then people tend to slow down through their 70s. That's not across all, but typically that's what we tend to see before perhaps later in life the consideration of care and things like that come along. So yeah, it's about mapping that journey out, isn't it?
And how long is someone going to spend retired?
Well, so this brings us on to our first slide here. And I think what this shows is life expectancy here and how that's changed over the years. So when we go back to to the early 1900s, when the state pension was initially introduced, someone that reached 65 was only expected to live on average for an additional 10 years. As we see it today, I mean, this only goes up to 2010. It's crept on a little bit from there. You can see that's now approaching 20 years, so nearly double the length of time. And therefore, any savings that have been built up to that point are going to have to work even harder to last that additional length of time.
And really importantly, when considering the amount of time someone spends retired, is something people are slightly more aware of over the past couple of years. That's the impact of inflation upon their retirement savings and income needs.
Absolutely, yeah. Unfortunately, inflation is one of those things that's with us and will be with us. I mean, if we think about, governments may sort of pretend that they're trying to target and tame inflation, but really it is the way that they pay back, the national debt, by inflating it away in reducing it in real terms. So it is something the monetary system is designed around, small manageable inflation. We've had quite a nasty shock. So again, this is a really important thing to factor in going forwards. And I think it brings us on to our next slide quite nicely. If we have a look here, that what you can see is that the power of just relatively modest inflation. So this shows what inflation has been just at 2.5% over a 25-year period. That nearly reduces your spending power by half over that time. So it's really important when you're looking at providing an income over retirement for those years that we also factor in inflation to make sure the goods and services that you can buy today, the lifestyle you can enjoy today, is maintained throughout that period.
And if clients are relying upon investments to offset that impact of inflation, sort of growing ahead of inflation and providing an income that can grow over time with inflation, really is the lowest bar that must be met, isn't it?
Absolutely, yeah. As we've shown, the power of inflation to erode that money is absolutely the first hurdle that we've got to try and target to make sure that, as we said, real income is maintained over that period.
And while some income sources in retirement will be inflation linked, such as the state pension, where an individual is relying upon investments and that sort of thing, it's really got to be at the forefront of any plan.
Absolutely, yeah. And I mean, luckily, the state pension, we benefit from the triple lock that's there, but that's an index linked pension amount. And again, we need to make sure that however we structure a client's retirement income is taking into account that and building upon it.
So while we know inflation is going to be ever present in some form or another, what we can be fairly certain of is that the future is uncertain. So how does an individual go about ensuring that they create a plan that can deal with those uncertainties?
It's a very good point. Yeah, I mean, by its very definition, the future is entirely uncertain, and what we've got, our role is here is to how to manage some of that uncertainty and help clients build resilience into their future plans. If we come on to the next slide, a good framework and how I like to think about this is based on Donald Rumsfeld. For those who don't know, he was the ex Secretary of Defense, US Secretary of Defense under George W. Bush. And he broke it down. It's a slightly simplified version, but broke down knowledge, if you like, into three camps. The first is the known knowns, things that we know. And in terms of financial planning space, this could be things like we know our current assets that we have, we know our current liabilities, we know what we earn, we know when we really would like to retire. And then we have the known unknowns, those things that we know we don't know, the gaps in our knowledge. And you can see here, we don't know when we're going to die. Slightly morbid, but that's the reality of things. We don't know how the legislative framework is going to change going forwards. This last October budget was a real eye-opener to that. Yes, tax rates may change, but actually sometimes other things change as well. So we have a lot of regulatory changes, the markets, geopolitics, all of these things are going to change. And we've got to try and work out a way to try and manage that with our clients. And then finally, we have the unknown unknowns. And obviously, we don't know what we don't know, but certain things like COVID, that was on no one's radar before 2020, really. And also, I guess, the secondary effects of the Russia-Ukraine war, the inflationary spike that came from that. So it's all about thinking about how we can manage those. Known unknowns, obviously, we can plan for those quite well. The known unknowns present some challenge, but how do we protect against premature death? We have health, life insurance, ill health. We have health insurance to cover those. It's the unknown unknowns that present more of a challenge, and that can be how we start to think about the planning process to make sure that people are still resilient if any of those unexpected things come along.
And when it comes to the unknown unknowns, I think that really drives home the importance of having an emergency fund, which we speak to all clients about, just to ensure that you have that liquid, readily accessible capital to meet those events that might crop up.
Absolutely. I think the term is you don't want to be a forced seller, do you? You want to be able to sell assets at the timing of your choosing rather than being put in a position where you are forced to do things. And, again, have an emergency part insurances, they'll help to ensure that is a possibility rather than being forced.
Yes. And more generally, thinking about how this can apply to retirement planning, I know I've certainly had conversations with clients about where the income and assets are more heavily skewed towards one individual in a partnership. What happens if that individual passes away first and various pension death benefits aren't sufficient to ensure that the surviving partner is financially secure, and how do they start planning to mitigate that?
Absolutely, it's really important. That is the planning process, isn't it? By thinking of all these things that can potentially trip up that plan and giving them consideration, we can plan for that eventuality, no matter how undesirable it is to start thinking about these things or wishing them.
And thinking back earlier to how we demonstrated people are living longer nowadays. Unfortunately, they're not necessarily living healthier lives. So we do see individuals who in their later years require fairly hefty care fees to meet their care needs.
Yeah, and that's all something that can be planned into it to make sure that we've covered that off at the end of sort of nearer to the end of someone's life stage. But really important consideration now, because we've seen inflation really impact care centre and care costs and the impact that has on clients.
So when we think about creating a retirement plan for clients, we use those known knowns to create a plan. But just because of those known unknowns and unknown unknowns, plans do tend to go out of date fairly quickly. However, the planning process is invaluable because it really highlights where an individual is exposed to those various risks and helps them to understand what steps they can take to mitigate them.
Exactly. And I think once you're aware of a risk, you can make an active decision about it, whether you do want to cover it or not. But it's an active decision rather than it just being, life coming along and sort of hitting you where it hurts at the wrong possible time. You've been able to give it some consideration. So totally agree. The process itself is invaluable.
So we thought about how much an individual might need to meet their expenditure needs in retirement and the impact of inflation on that, and also what curveballs life may throw their way in order to change that income need. So now we need to think about where they might draw that income from. How are they going to meet that expenditure need and the tax considerations of all of that? So let's start with something that really shouldn't be underestimated: the state pension.
Absolutely. And I think underestimated is the word. People sort of gloss over that slightly, yet it is a really good foundation, the bedrock of someone's retirement plan. Albeit the age at which you can draw it is being pushed back, but the state pension next year is state pension is going to be just under £12,000. Now, looked at some numbers last week, and to purchase the equivalent income of a state pension would take a capital sum of roughly £250,000. So for an individual, so that really isn't to be sniffed at, and as I said, can form a really solid bedrock. After that, I mean, really, still the best savings vehicle for retirement is pension. So I know they've taken a lot of flack. Governments have come and gone and tend to use them as a sort of a source of generating more tax revenue, but nonetheless, think the tax relief on the way in, unparalleled, the growth, almost tax-free, entirely tax-free growth whilst you're in there, very, very attractive. The ability to draw 25% out as a tax-free lump sum up to certain limits, very attractive again, but also the death benefits. Death pre-75, pot could be passed to the spouse free of tax. So again, really, really attractive way to save for retirement.
Especially where an individual is employed and benefiting from employer contributions into that as well.
Particularly, yeah, and what you've seen is the state mandate now saving for a pension through the employer. All employers are obliged to provide a workplace pension and generally match contributions. So I think what we're seeing, the onus is moving away probably from the state far more to the individual to make their own, to make retirement put it in their hands.
So you've said the pension is the primary savings vehicle for retirement. What else might an individual look at beyond their pension?
So probably the next most attractive tax wrapper after pensions are ISAs. Slightly different. ISAs are paid into or contributed to out of net income. That's after tax has been paid. Each individual has a £20,000 limit, whether that be in a cash ISA or a stocks and shares ISA. There has been some talk whether it goes through that cash ISAs might be reduced, but we'll wait and see till the budget comes through. But again, assets in there grow entirely free of, or almost entirely free of tax. And also anything that's drawn down from it is free of tax. So they become a very, very useful tool to draw a tax-free income in retirement.
And thereafter, we might look at ways of utilizing an individual's dividends allowance, capital gains tax allowance, and possibly some tax-deferred tax wrappers such as offshore bonds.
Absolutely. There's a lot of tools out there. Our role is to help structure individuals' assets in the right way so that they've got all these different levers they can pull at the appropriate time. Governments are very good at sort of turning off one tap and making sort of it a bit more uncomfortable to draw income in one way. What we want to do is to make sure our clients have the maximum flexibility so that if that door closes, another one could open.
And what I cheekily call sort of legislative diversification, ensuring that you have those different pots that can be drawn on at different times, depending on their relative attractivenesses. But also, importantly, some pots provide more flexibility than others when it comes to drawing an income. For example, the ISA, because that is free of any further tax when you draw upon it, that is a good element to use for some of those unknowns that we talked about earlier. If an ad hoc withdrawal is needed, then that can be a better option than the pension, which you might have a more fixed plan using those tax allowances. So should we just talk people through how we might create a retirement income plan?
Absolutely, yeah.
So for those who don't know, everyone in the UK receives what's known as a personal allowance under most circumstances, which is the first £12,570 of your income is tax-free. And as we mentioned, these days, because the state pension has been growing with inflation, whereas the personal allowance has been fixed for a few years, the state pension is from April going to almost entirely use that personal allowance. Thereafter, most individuals I talk to are prepared to pay some element of the basic rate band. That's 20% for those in England and Wales. And we might take pension withdrawals for that, up to £50,000, just above, with the 20%. Thereafter, we're more likely to explore other options that are either tax-free or tax-deferred, such as those ISAs. And I created a retirement income plan for a client just the other week, where they required an £80,000 a year net income, and they only needed to pay about £8,000 of income tax on it, which, as you won't need to be a maths genius to work out, is a 10% aggregate rate of income tax, which really is not that bad if you look at sort of global averages.
Yeah, I really don't think that should be underplayed. That actually, whilst we all moan about the burden of taxation in the UK at those lower rates, I think we do have one of the lowest tax burdens as individuals within Europe. So the ability to create a really tax efficient income that should generate a very relatively good standard of living shouldn't be dismissed.
The caveat there being you need to have planned ahead in order to get those assets into the various tax wrappers which provide those.
Yeah.
Lovely. So thinking about where they should be drawing from, we now need to work out how much they need in each pot in order to provide that income that we've established. So what's the safe withdrawal rate in order to reverse engineer that?
Well, this is the $1 million question, isn't it? And which clients ask us, and the reality is there is no safe withdrawal rate when we're discussing investments. For absolute safety and guarantees, then sort of annuitizing that income stream is the best option, and that.
And just to explain, an annuity being a guaranteed income for life, handing the risk over to an insurer in order to provide that.
Absolutely. And the quid pro quo is that you lose all access to that capital and the flexibility that can have. Now, that may be appropriate for some people at certain times in life, but for many it's not. So we have to work in a dynamic system whereby look at it almost like a heat map. Sort of the longer you plan to live for, the longer you plan to draw down, the more money you're going to plan for or plan to withdraw, then actually the risk is going to go up slightly in terms of how you can sustain that income. A lot of it is going to be dependent on the rates of return that the investments achieve. So you've got to look at it in a very dynamic manner, and there is no sort of one simple answer there.
And that you're right, there is a natural tension there, isn't there, between that risk of living too long, which is a slightly odd concept to get your head around, and the investment risk needed to take. Because, of course, with greater investment risk, you have greater risk of short-term falls in the value of your investments, but the offset of that is you hope for greater long-term returns. Those short-term falls do start to work against you when you're drawing down on your assets in retirement. That compounding effect that's been working for you as you've been growing your assets suddenly starts to work against you.
Yeah, and I think of it in this way, that actually the greater short guarantees you require in the shorter term, that's going to play against you over the longer term and vice versa. So it really is a balancing act. You've got to sort of walk that, not tightrope as such, but you've got to get the balance right. And that's why it is so individual to each client as to how that looks.
And there's also that interplay between the short-term risks and the long-term risks in terms of inflation. Take too little risk and you run the risk of your long-term growth not keeping pace with inflation. Take too much and suddenly you're exposing yourself to those short-term falls. So we've talked an awful lot about risk. How might individuals help to tread that balance line between the two and have peace of mind that they're on the right track?
Well, I think the answer to this is core to sort of part of the planning that we provide our clients with, and that's looking at the cash flow planning, which some clients may be familiar with, others may not. I think for those that not, it would probably be quite a useful exercise just to walk through.
Yeah, absolutely. So on to our next slide. For those listening who haven't received a cash flow plan, it is a model into which we put all those known knowns that we mentioned earlier: your income, your expenditure, your assets, your liabilities. And then we start to project forwards, making certain assumptions about those known unknowns, how those might change in future, but also assumptions about inflation, investment growth, and longevity, how long you might live for, making conservative assumptions on all three of those, because we want to ensure that we're planning on a worst case scenario, that we're not just hoping for the best. And that process can really highlight where there might be, for example, in the first figure on your screen there under the number 1, a shortfall shown in red. And if it's identified early enough, the earlier the better, because it can help an individual understand how much more they need to start saving for their retirement planning, or do they need to adjust their expectations and perhaps retire a little bit later.
And as you alluded to earlier, compounding is your friend when you are accumulating assets, and therefore the sooner that you can course correct, the sort of the less costly that's going to be, isn't it, with time on your side?
Absolutely. And once we've established that core, that base scenario, then we can start to have some of those what if discussions with clients, to understand where their priorities lie between perhaps saving a little bit more in the short term, in order to enjoy retirement a little bit more later on, or whether they are prepared to work a bit longer in order to meet their goals. And we can also start to factor in some of those negative what if scenarios. What if my partner passes away early? What if we have a significant market event on the day that I retire? What, for example, March 2020 and COVID, what if that had happened on my retirement date? Would my plan be resilient enough to survive that? Or am I flexible enough to mitigate that risk?
Yeah, absolutely. And also we're seeing clients that are moving towards the end of their careers, and they want that reassurance to understand that work, whilst it's, have they got the choice of carrying on working, and it's not an obligation anymore. And that gives a lot of peace of mind to understand and really take it at their pace, that transition from a working life over into retirement, which tends not to be a cliff edge anymore.
Mm. And as I mentioned earlier, plans tend to be relatively short-lived because the future is uncertain. So this process is iterative and ever evolving. We would explore this in future to make sure that whilst approaching retirement, an individual is still on the right track. And whilst in retirement, it helps them walk that balance beam between spending too much and artificially restricting themselves and spending too little because they're afraid they're going to run out of money. So generally bringing things to a close now, that process should hopefully, once you've gone through it, provide you peace of mind that you're making the right decisions. I mean, making the step into retirement is one of the biggest life changes an individual will go through. So hopefully we've provided some food for thought there by exploring how much income you might need in retirement and how to work that out, including how it will change over time, how to manage that uncertainty around life events, tax and investment considerations in retirement, and finally, how to test and prove that you're on the right track and provide some peace of mind there. If any of the topics today have resonated with you, we'd really encourage you to reach out to your Canaccord contacts to explore them further and start that planning process soon, because as the old proverb says, the best time to start planning was 10 years ago. The second best time is today. Thank you very much.
Many thanks.